Are you wondering whether sticking with a traditional bank is costing you more than switching to a digital one? With digital banks offering lower fees, higher interest rates, and 24/7 convenience, it might seem like the obvious choice. But traditional banks still provide in-person service, stability, and long-standing trust that many people rely on. In this video, we'll break down the real costs, hidden fees, and benefits of both options, so you can finally decide which one truly saves you money. So before we start, make sure to hit the like button and subscribe to my channel. The shifting financial landscape. The financial landscape has undergone a dramatic transformation in recent years, with the rise of digital banks challenging the long-standing dominance of traditional brick-and-mortar institutions. This shift has presented consumers with a critical question: which type of bank offers the most significant financial advantage? On the surface, the answer seems straightforward. Digital banks, with their promises of lower fees and higher interest rates, appear to be the clear winners. However, a deeper, more nuanced analysis reveals that the true cost of banking is far more complex than a simple fee comparison. To determine which one actually saves you money, we must dissect the intricate financial models, operational costs, and hidden charges of both digital and traditional banks, while also considering the less tangible factors of convenience and service. The impact of operational costs and fees. The most fundamental difference, and arguably the most impactful for a consumer's wallet, lies in the operational cost structure. Traditional banks are burdened by a vast and expensive physical infrastructure. They must maintain thousands of branches, pay rent and utilities for prime real estate, and employ a large staff of tellers, loan officers, and managers. This massive overhead is a significant drag on their profitability, and as a result, these costs are inevitably passed on to the customer in the form of various fees. These can include monthly maintenance fees for checking accounts, fees for using out-of-network ATMs, and charges for services like wire transfers, cashier's checks, and even printing paper statements. For a customer with a modest balance or one who doesn't meet specific monthly requirements, these fees can quickly erode any savings they might accumulate. In contrast, digital banks operate with an almost non-existent physical footprint. They have no branches, no tellers, and a much smaller staff, as most customer interactions and processes are automated. This lean, technology-first model results in operational costs that are often 60% to 70% lower than their traditional counterparts. This colossal cost savings is the primary reason digital banks can afford to offer their services with minimal or no fees, providing a direct and tangible financial benefit to their users. The advantage of high-yield savings accounts. Beyond just the absence of fees, digital banks leverage their lower overhead to offer more competitive interest rates, particularly on savings accounts. Traditional banks, with their high operating costs, have historically offered abysmal interest rates on savings, often hovering around the national average, which is a fraction of a percent. This leaves a consumer's money stagnant, losing purchasing power to inflation over time. Digital banks, however, are in a position to offer what are known as high-yield savings accounts, HYSAs, with annual percentage yields, APYs, that can be 10 to 20 times higher than those of major traditional banks. For a saver, this can mean the difference between earning a few dollars a year and earning hundreds or even thousands on a substantial balance. This compounding interest is a powerful wealth-building tool, and for many, it is the most compelling reason to switch. By moving a significant portion of their savings from a traditional checking or savings account to a high-yield digital account, customers can generate passive income without any additional effort, effectively making their money work for them in a way that traditional banks have largely failed to provide. A deeper look at hidden charges and penalties. The hidden costs and fees associated with traditional banking also extend to unexpected charges that can catch customers off guard. Overdraft fees are a prime example. Traditional banks have long relied on these fees as a significant source of revenue. If a transaction pushes a customer's account into a negative balance, they can be hit with a hefty fee, sometimes as high as $35, for each occurrence. This can create a devastating cycle for those living paycheck to paycheck, as one small mistake can lead to multiple fees that are difficult to recover from. Many digital banks, on the other hand, have eliminated overdraft fees entirely. Instead of allowing a transaction to go through and charging a fee, they simply decline the transaction or offer temporary fee-free overdraft protection. This fundamental difference in philosophy, prioritizing financial stability over revenue generation from customer mistakes, directly protects consumers from a common and costly pitfall. The value of traditional banks for complex financial needs. However, the financial picture is not entirely one-sided. Traditional banks have built their model on a wide range of services and products that digital banks often do not offer. For instance, obtaining a mortgage, a personal loan, or a business line of credit often requires in-person consultation and relationship-based banking, where a customer's history and personal rapport with a loan officer can influence the terms of the loan. Traditional banks have a physical presence that facilitates these complex, high-stakes transactions. They also provide services like cashier's checks, safe deposit boxes, and easy cash deposits, features that are either difficult or impossible to access with a purely digital bank. While a digital bank may be cheaper for day-to-day transactions and savings, the long-term relationship-based financial products offered by a traditional bank could, in some cases, provide greater financial benefits over a lifetime. For a small business owner who needs to deposit cash regularly, or a home buyer seeking a personalized loan, the value of a physical branch and a face-to-face relationship can outweigh the cost savings on monthly fees. Convenience, accessibility, and financial control. The issue of convenience also plays a subtle but significant role in saving money. While the idea of a physical branch may seem outdated to some, for many, it provides an invaluable sense of security and accessibility. The ability to walk into a branch and resolve a complex issue with a human being, or to receive a notarized document on the spot, can save hours of frustration and potential financial loss. Traditional banks also often have a more robust and established network of ATMs, which is a major advantage for those who rely on cash. However, digital banks offer a different kind of convenience: 24/7 access to your finances from anywhere in the world. This round-the-clock availability allows for real-time monitoring of spending, instant fund transfers, and immediate bill payments, which can help customers avoid late fees and maintain better control over their budget. Features like expense categorization and spending insights, common in digital banking apps, can empower users to identify and cut unnecessary costs, indirectly leading to greater savings. Security, regulation, and customer protection. The security and regulatory framework governing both types of institutions is another factor to consider. Both traditional and reputable digital banks are typically insured by government agencies like the Federal Deposit Insurance Corporation, FDIC, in the United States, which protects deposits up to a certain amount in the event of a bank failure. However, the nature of the banking models means their security focuses differ. Traditional banks must secure both their physical and digital assets, while digital banks pour all their resources into robust cybersecurity measures. They employ advanced encryption, multi-factor authentication, and real-time fraud monitoring to protect customer data and funds. While traditional banks have also made significant strides in digital security, their legacy systems can sometimes be more vulnerable. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.